What is up, guys, and welcome to Lecture 7 here at the TCT mentorship, where we will be talking about risk management. And, guys, this is by far the most important lecture in this entire mentorship, because no matter how good your technical analysis is and your understanding of TCT schematics, without proper risk management, you will never become profitable. Okay? Never. And it surprises me that there's such a big misconception about risk management and also the use of leverage, which, in my opinion, is the first thing you guys should be learning and should be trying to understand when getting into trading. Because trading is a longevity game. You want to stick around for a long time so you can enjoy the profits later on. Okay? So, what exactly is risk management? Well, risk management basically boils down to risking a smaller percentage of your total account trading balance so you can lose multiple times in a row and still be able to continue trading without having to add new funds to the account. And this risk percentage per trade usually lays in between 1 to 3% of the total account balance. Meaning, if you have $5,000 in your trading account, the average risk you take per trade will be between $50 to $150, which is equal to 1 to 3% of your trading account. And what you will see when you study traders that apply proper risk management versus traders that don't is the difference in a very big difference in equity trend. So in trader A right here, we have a trader that applies proper risk management. And what you will see is that his equity trend, so his total account balance over time, will slowly increase in a consistent way. Okay? You have ups and downs. You have moments where he loses a bit more, but then he picks back up and he starts winning again. But it's a slow and steady grind up. That's the signs of a profitable trader that applies proper risk management. Now, if we look at trader B, what you will see is that probably in the beginning, he gets lucky and he wins. And when he wins way more than he actually should win because he's over risk on the position. So he will have way sharper moves in his equity trend from growing incredibly fast, but then losing it twice as fast. And you will have those moments where you actually make good money and your account balance spikes up. But over time, you will always end up net zero. You will always end up net zero because they will get greedy, they will revenge trade, and the profits will not stay in the account if you don't apply proper risk management. And trust me, guys, I'm talking from experience because I was trader B back in the day when I didn't understand it. Okay, now I'm a trader A. I actually showed you guys my equity trend not so long ago on my Mexi trading account, and it looks something like this. Right? Because no trader has a 100% win rate. But when you manage your losses and make sure that your wins always end up being more than your losses, you will have an equity trend that looks like this. Okay? So, let's pull up the risk to reward. So, what is risk to reward? Because everything boils down to risk to reward. And risk to reward is just referring to how much are you making based on the amount that you are risking. Okay? So for example, if I say my average risk to reward is 2, that means if I risk $50 on a trade, I tend to make $100. Or if I risk $150, I tend to make $300 on each trade. And as you can see right here, I have the long position 2 open. And right here in the middle, you can see risk to reward ratio that equals 2. So that means if I enter this trade with a $50 risk, that means if I lose $50. But if I win, I make 100. So it's a 2 to 1. Okay? You're making twice as much as you are losing if you lose. That's basically what risk to reward is. How much are you making based on the amount that you are risking? And risk to reward is everything, okay? Everything in trading is based on risk to reward and the percentage of the trades that you win. So let me pull up an example to show you guys. So Like I said, everything in trading is based around risk to reward and the percentage of the trades that you win. So let's say you had a terrible trading week and you lost 6 times in a row, risking 1% on each trade, while every trade had a risk to reward of 3. Meaning, if you won the trade, you would have made 3% on your account balance. Okay? So, applying compounding, if you had a starting account balance at the beginning of the week that was 10,000 and you lost 6 times in a row, after that 1 week of trading, your account balance would be $9,414.80. Okay? You can see the trades right here. Every time you lose 1%, that's why I multiply it by 0.99. And you see after 6 trades, you went from 10,000 to 9,414, which is a bit less than 6% because you're compounding. Okay? So after 1 week, your trading account balance after compounding will be $9,414.80. Now, let's say the next week, you won 3 times in a row. But every time you win, you aim for a 3% gain, meaning a 3 risk to reward. Meaning if I multiply that $9,414.80 by a 3% gain, because we're risking 1% and we're aiming for a risk to reward of 3, after only 3 trades, you are back at an account balance of $10,287.81. So as you can see, after only 3 good trades, the total account balance is well up into profits, 2.87% to be exact. So even though out of your last 9 taken trades, you lost 6 and you won 3, you can still make very good money. Because the higher the risk to reward, the lower the percentage your win rate can be. Because you win way more than you lose. So you can lose multiple times in a row, but because you win way more when you win, you can have a lower percentage of a win rate. And you can still make very good money. As you can see right here, risk to reward, you can see it right now, I increased it and it says 3, meaning if you lose a trade, you lose 1% of your account balance. If you win, you gain 3% on the account balance. Okay? So that's why there are traders out there that have different styles. Some traders, they win very little, but when they win very big, meaning they have a very high risk to reward ratio and a lower win rate percentage, and they can still make money. Here at TCT Trading, my win rate is around 70 to 80% on a consistent basis over, I think this is like data over almost 200 trades. And my average risk to reward is 2.3. Average risk to reward is 2.3. So you can make the calculation of the money that you can make when having a high win rate and a good risk to reward. Because that is what TCT concepts allow you to have. Now, I already know that, let me tell you one more thing. Okay. Everything comes down to risk to reward. Okay. The percentage moves do not matter. Listen closely. The percentage of the move does not matter. Let me show you an example. Okay. Let me show you an example in the chart. Let's say trader A catch the exact bottom, okay? Trader A catch the exact bottom on Bitcoin. However, his invalidation was right below this candle's low. Talking about this candle right there, that was his invalidation, okay? He could have caught the exact bottom. And then let's say he took it up all the way towards that high. He could have cashed out perfectly, okay? He could have cashed out perfectly. It may be a 32% move in the Bitcoin price, but that doesn't matter. We just need to check the risk to reward ratio, which is 7.17. Meaning if he risked 1% and he catched the exact bottom, he would have made 7% on his account. Now, trader B, for example, he could have caught a low time frame entry right here, put a stop loss below that wick, and target the exact same point. And as you can see, trader B, who ended up entering way higher, catching less of a percentage move on Bitcoin, has a higher risk to reward ratio than trader A, because his invalidation, his stop loss size is smaller. So it's all risk to reward. If someone posts a screenshot of his percentage gain without showing the setup behind it and the invalidation and this long tool with the risk to reward, it doesn't matter. Because what if he just entered here, but his invalidation is all the way down at 42K? Then his risk to reward is only 2. Meaning if he had a $10,000 account, he would only make $226. Whereas trader B, who entered way higher, targeting the same level, makes way more, $750. So this doesn't matter, okay? Percentage moves, the 32% doesn't matter. It's all about the risk to reward. Trader A, only 2.26. Trader B, 7.5. And trader B will make way more money. That's why you also don't have to worry to catch the exact bottoms and the exact tops, because maybe there was no entry in here, but that's totally fine, because we can catch a local entry right here where we have a 1, we have a 2, and we have a 3, and we enter way up here, but with a very tight invalidation and a good target, giving you right here, if you entered on the breakup structure, for example, a risk to reward of 5, which is extremely good. Whereas someone that may have caught the exact bottom and he took the SFP and he put his stop loss below the low and he targeted the high, he only makes 2%, a risk to reward of 2. So even though you entered higher, catching a less of a percentage move, your risk to reward is higher. And you make more than trader A. Obviously, if trader A applies proper risk management, where if he doesn't, in the long term, he will not make money. So everything comes down to risk to reward per setup. Now, I already know that some of you are going to be like, but if I only risk 1 to 3% per trade, it will take me so long to become financially free. Right? I just know some of you are going to think that right now. But if I only risk 1%, how am I going to make money? Guys, even though that's very tempting to say, if you do the proper math, you realize you are completely wrong. Okay? So I want to show you the power of making 5% a week. Okay? It's around 1% a day if we don't count the weekends. But 5% a week is something I have been averaging consistently each week for 5 months now, live on YouTube. I don't know for the person that's watching this how long you've been following me, but I've been averaging 5 to 10% each week for 5 months now. So it's literally possible. I have shown you guys on YouTube. You can go back in time and you can watch it, right? But it's 100% possible when trading TCT schematics, okay? So I want you to do the math, and I have kind of already done it for you, so just listen to me. The power of making 5% a week. If you have a starting account balance, that's 10,000, and there are around 35 trading weeks in a year, okay? You have holidays and, vacations, all that stuff. That means if you make 5% a week consistently, just checking from a compounding perspective, from a weekly perspective, okay, compounding effect from a weekly perspective, which is less good than a daily perspective, which is usually is. So this is the minimum. After 1 year of trading, you will turn your 10,000 into $55,160.15. After year 2, that will be more than 300,000, and after year 3, you will be a multi-millionaire. So in only 3 years of trading, you would have turned 5 figures into multiple 7 figures. which is absolutely insane. Okay? Now, these calculations are based if you only use your own capital. Okay? However, if you're starting out with a smaller starting capital, I suggest you use prop firms to build up your starting capital and then you ditch them again because they are riskier with payout denials and all that stuff. But let's say you have $1,000 as a starting account balance. Now, you buy a challenge of a prop firm, which will be like around $500 if you want a 100K account. And in order to get the account, you have to pass 2 phases. Probably phase 1 is 10% and phase 2 is 5%. Whereas if you make 5% a week, it will take you around 3 weeks to pass. And then normally you have to pay out every 2 weeks with an 80% profit split. So if you make 10% in those 2 weeks, right? Every payout will be 8K. 10% of 100K is 10K, and then 80% profit split makes it 8K. Now, if you do that for 32 more weeks, because it took you 3 weeks to pass, and we have 35 weeks in a year, you would have made $288,000, okay? After only 1 year of trading, starting with a $1,000 account balance. Now, you take that starting, or you take that money, you ditch the prop firm, and now you start trading with your own capital. And then in your second year, you would turn that into 1.6 million, around 1.6 million. And guys, this is only by making 5% a week. For the people that have been following me, I show setups, just a single setup that's already a 5 risk to reward. And that's one trade setup. You only need 5% in a week in order to make these results. I've shown you multiple setups of 3+ risk to reward, sometimes even 9. Sometimes there's even a banger that's like 10+. But either way, the consistent gains count. Only 5% a week. That's like 2. You only need 2 trading setups that have a good risk to reward of 2.5 and you're done. And trust me, they come every week. Promise me, when I say this, they come every week. Now, I know there are still going to be some of you out there that think 3 years is too long or 2 years is too long. Guys, you need those years as a trader to develop. If I were to give you 1 million right now, there's no way your trading psychology can handle seeing your P&L fluctuate with 5 figures. Because that money is incredible to you. You put too much value into that money amount. And you're going to stress if you see minus 5,000, and you're going to take profits too soon when you see plus 20K. If I give you high amounts of money right now, you're going to be trading profits, and you're not going to be trading the plan. So you need those years to get used to the higher amounts of money. Okay? When you built your own capital from 10,000 to 1.7 million, you can actually handle the 1.7 million. If I gave you that right now, you would shit your pants. You would literally shit your pants. So you need those years to, one, evolve as a trader and increase your skills and your mental trading capacity. Okay? You get used to slowly seeing an increase in your money amounts. Therefore, you can also trade with more money. So don't think this is too long. If you think 3 years is too long to become a multimillionaire, you want it in 1 year, most likely you will be over leveraging, you'll be over risking, and you'll be trying to get everything too soon. And the harder you chase wealth in this game of trading, the more resistance you will find. But I'm showing you the possibilities that in literally 2 years, by just sticking to a 1% risk rule, between 1 to 3% depending on the quality of the setup, by making only 5% a week, you can literally become a multimillionaire in 2 years. So just listen to me and promise me that you'll apply good risk management. Even if I share a setup with you guys in the VIP Discord, I am still sticking to my risk rules. So don't over leverage, don't over risk. Not even over leverage, because that's something we're going to get into now, but don't over risk. Never over risk. Stick to that 1 to 3% because you only need 5% a week to be financially free for the rest of your life. So, second point, very important. How do we calculate our position sizes so we can actually apply proper risk management? Because that's very important. So let's pull up the chart where I have an example for you guys. So, as you can see right here, these are the formulas where we calculate our position sizes. In my opinion, I don't think anybody calculates it like me, and it's literally the fastest and easiest way to do it, in my opinion. So let me explain. Right here we have a beautiful Model 1 TCT distribution schematic that went over into a Model 2 where we grabbed that extreme liquidity point and then we broke structure. So as you can see right on that break of structure, that's where I entered. And the risk to reward in this setup is 2. Okay? So if I risk $100, I make 200. Now, to calculate our position size for crypto, we use the formula risk amount in dollars divided by your stop loss size in percentage, mile, or times 100. That equals your position size. So, if I want to enter this trade and my account balance is $10,000 and I want to risk 1%, which is $100, my position size on this trade will be I divide my $100 by 0.26, which is the size of my stop loss, as you can see right here, and then multiply it by 100, giving me a position size of $38,461.54. It's that simple. Reasoning behind this little formula is that your position size equals 100%. So if your stop loss needs to be equal to $100, that means 0.26% is equal to $100. Well, the position size is 100%. So to get 100%, you just divide the 100 by 0.26, multiply it by 100, and you have your total position size. That's it. Now, for Forex and gold, it's a bit different. The starting formula is the exact same, right? You have your risk amount in dollars, you divide it by your stop loss size, and you multiply it by 100. However, Forex works with lots, okay? So you have to fill in the amount of lots that you want to enter the trade with. And one lot is 100,000. That is because in Forex, the percentage moves are way smaller, making your position size way bigger because you divide by a smaller percentage, meaning your position size will be way bigger. And therefore, they have lots. So you don't have to fill in, I want to enter with 2.7 million. No, you just enter with 2.7 lots or 27 lots. Okay, so what you do is after you do the normal calculation, you just divide it by 100,000 to get the amount of lots. And for gold, it works the exact same. However, for gold, one lot is the price of gold, so PG stands for the price of gold, times 100. Okay? So one lot in Forex is 100,000, and one lot in gold is the price of gold mile 100. So if this was a Forex position, I would have to divide this by 100,000, and I'll get something in a 0.3 lots. Okay? And that's basically it. It's very simple. You pull out your short tool. You check, okay, what's my percentage stop loss? And you just divide your risk dollar amount by the percentage of the stop loss, and you multiply it by 100. Very quick. You can be done in 1 second with calculating the position size. And this already is a very good introduction to leverage. Okay? It's a very good introduction to leverage because, as you can see, in order to fill this position, I need $38,461.54 if I want to risk $100. However, my account balance is only 10,000. So without the use of leverage, I cannot fill this position, even though I only want to risk 1%. So when people are talking about, oh, don't use leverage, leverage is gambling, leverage is too risky, what do they mean? I want to risk 1% of my account balance, but because I'm scalping on the lower time frame, making my percentage moves smaller, I need leverage in order to be able to risk only 1%. That's it. That's why I don't understand when people talk about, oh, yeah, I over leveraged. What do you mean you over leveraged? Leverage doesn't matter. You over risked. You risk a higher amount than you can handle. Okay? So, our account balance is 10,000. We need 38,000. The leverage we need is therefore we just divide our position size by our account balance. So the leverage needed is dividing your position size by your account balance. So dividing it, you get 3.85x. So the minimum required leverage, in order to fill your position, we would have to use full margin. Okay? So I have a $10,000 account balance. If I want to fill my position, I need a minimum of 3.85x leverage. If I select that amount of leverage, I would have to put up $10,000 of my own money, and then I can multiply with the leverage with 3.85 and I can fill the position. But that requires me to use my total account balance in that trade, which can be pretty inconvenient if I, let's say, have another setup I want to take, right? Let's say this trade ends up being a swing run, right? It runs way more down and I want to hold it. Well, I already used up all my account balance for this trade, so I have no more money to enter another trade. And this calculation just calculates the minimum required leverage in order to fill the position, and we would have to use full margin for this. And margin is simply a definition or a term that simply means how much money are you putting in the trade. So if I say we have to use full margin, it means we have to put up our entire account balance in that trade. Okay? While still only risking 1%. Keep that in mind. We're only risking 1%. It's just a smaller trade setup, meaning we have to enter with more to still risk 1%. Now, we can also put the leverage on 30x, okay, while keeping our risk the exact same. It just means that we put less of our own money in the trade for potential other trades that could appear. So what happens if I use 30x leverage? Well, that just means that if I use 30x leverage, the money that we have to put in the trade ourselves will simply be dividing the position size by the leverage, and that will be $1,282.05. So it doesn't matter if someone took this trade with 3.85 leverage or 30 leverage. The risk is the same. That's it. The leverage doesn't matter. The leverage does not matter. I could also enter this trade with 60 leverage. I'm still risking $100. It just means I'm putting up less money myself in the trade. Because now we have $8,717.95 in our account to still trade with for potential other setups. So if someone posts a screenshot of 400% gain while being on 100x leverage, that means jack shit. That means absolutely nothing. Absolutely nothing. It just means we just want to know what risk amount did you put in the trade and what is the risk to reward. Because I can enter this trade with 3.85 leverage and make the same amount of money as if I were risking or if I were putting up 30x leverage. My risk dollar amount stays the same, therefore my dollar take profit amount stays the same. It's just the margin. The higher the leverage, the less margin you put in the trade. But leverage itself doesn't matter. It literally doesn't matter. The only thing you need to be aware of is the liquidation price. Meaning the higher the leverage, the earlier or the closer by the liquidation price is. Okay, and liquidation price basically means if price exceeds that point, they just take your entire margin that you put up in the trade. Not your total account balance, just the margin you put in the trade. If you use isolated margin, always use isolated, okay? You have cross and you have isolated. Very important. When you use isolated margin, you only risk the money you put in the trade. If you use cross, they can take your entire account balance. So always use isolated. And just be aware that, let's say if I enter this trade with 100x leverage, that could mean that my liquidation price is here, while my stop loss size is here. And you never want your liquidation price to be below your stop loss when you're shorting, because that would mean your trade will already be taken back by the exchange prior to you actually hitting your stop loss. So always make sure that your liquidation price stays outside of your stop loss range, okay? And then you're totally fine. But I want to just change your guys' perspective on leverage. Leverage is just a tool where you can calculate how much margin you need to put in a trade in order to still risk the same amount. It doesn't mean that you're risking more if you're using higher leverage. You're just risking the same. You're just calculating what margin you're putting on the trade. And this is how those fake trading gurus promote all their scams, because they put up high leverage and then they press maybe like $3 and then they see a percentage, people see a percentage gain of 400%, while in the meantime they risk $3 and then they made maybe fucking, I don't know, $12 or not even, and then they people think they're the shit while they're not. They're literally not. Leverage basically calculates how much margin you put in the trade while risking the same. Everything boils down to your risk dollar amount and your risk to reward ratio. That's it. Leverage does not matter. Does not matter. It matters when you have a smaller account balance and you want to risk higher, okay? So let's say I only have $1,000 in the account and I want to have a 4% risk because I really think this setup is going to be good. You just need leverage in order to fill that position, right? But it's all about how much are you risking. And if you're risking that amount based on putting up more margin yourself, you can use lower leverage. If you want to use less margin yourself, you put up higher leverage, but the risk amount stays the same. And one is not better than the other. Literally, one is not better than the other. So let me see if everything is going good. Everything is going good. So I hope I could kind of change your mind, guys, by showing you guys that percentage moves do not matter, risk to reward matters, and then how you can actually calculate your position size by just using this simple formula. And then you realize that you need leverage, but leverage is not depending on, or leverage doesn't have impact on how much you are risking. It just means how much are you putting up yourself for the trade to open. Okay? So that's why I don't understand people talking about over leveraging. Like, if you're over leveraging, it just means you're over risking, because you can use high leverage but still risk 1% of your account balance. They're not correlated that higher leverage means higher risk. So hope this makes sense to you guys. If you have any questions, just drop them in the Discord, and I'll try to get back to most of you. But yeah, I think this is something everyone should understand, right? Otherwise, literally, guys, if you don't understand it, your account balance will look like Trader B. It will look like Trader B, and you don't want that to happen, okay? You don't want this to happen, because this is what it will look like. Because you will over risk and you have amazing winning trades because everyone has beginner luck, and then you crash back down twice as hard. And all those spikes right here, these spikes that you see are spikes of hope. These spikes cause you to not switch to proper risk management because you just think of the possibility that it could happen again. But over time, everyone ends up being net zero and they will call trading a scam because they didn't understand that trading is a game of probabilities, and we just need to take multiple trades, execute while applying proper risk management with a good risk to reward and a decent win rate, and you are making money guaranteed if you have a backtested strategy, and TCT Concepts is a backtested strategy. So love all of you guys, and I'll see you in the next lecture.